Hi, everyone. Welcome to the Crypto and Blockchain Economics Research Forum. This is our online webinar series. My name is Will. I'm the host for today. And we have the great honor to have Toni with it joining us today to present her work related to central bank digital currencies, CBDC. Now, before we delve into the presentation and the discussion, let me just make a brief introduction of Toni before I offer her the floor. Actually, Toni doesn't need much introduction. I think we all know her very well. She is the Dale Decima Professor of Business Administration at Ross at University of Michigan. And she's taught a variety of areas in finance, including macroeconomics, finance, econometrics at the undergrad, MBA, and doctoral levels. She's published over 40 articles in top journals, and her research covers a wide range of topics. And she has won a Jensen Prize for one of the top articles in corporate finance, and twice won a Brettel Prize for one of the top articles in the Journal of Finance, again on the topic of corporate finance. She is the past president of the Western Finance Association, and she now serves as the editor-in-chief for the Journal of Financial Economics. Again, we are really honored to have Toni here. Now, the way we're going to run this webinar is that we'll have about 15 minutes of presentation, and in the middle, we will pause once to take questions as well. Everyone is welcome to put the questions in the Q&A. We temporarily disable the chat function, but towards the very end of the talk, we'll have about 15 minutes of open Q&A, and at that time, we'll enable the chat function or allow our audience to post the questions over voice. Now, during the presentation, I'll be collecting questions and monitor the Q&A box, and we'll pose some questions to Toni when it is appropriate. So with that, I would like to give the floor to Toni. Thank you so much for supporting our webinar and for joining us today. I'm looking forward to the wonderful presentation.
Well, thank you very much, and thanks for the very generous and nice introduction. Let me share my screen. And I think we're good. So this paper is called Will Central Bank Digital Currency Disintermediate Banks? It's co-authored with Yufeng Wu, who's at OSU, and Kairong Xiao, who's at Columbia. I know that everybody in this audience probably knows what a CBDC is, but I sometimes give this to macroeconomists, and they don't. So a CBDC is a country's official currency in digital form, and the question I get is, well, don't we already have that? Isn't everything digital? And the answer is yes, but a CBDC is different from existing digital money like bank deposits because it's a direct liability of the central bank rather than a commercial bank. It's also different from existing central bank liabilities like bank reserves because it can be held by the general public, not just banks. And it's been increasing in popularity. There are 11 countries, including Bermuda, that have launched it. There are several countries, including, and I think especially China, that have launched a pilot or more than one pilot. There are a lot of countries that are thinking about developing this, in particular in the North America. Canada is very interested in this. So there we go. But it's not without controversy. So this little quote is taken from a Federal Reserve publication from January of last year, and it says, a widely available CBDC could reduce the aggregate amount of deposits in the banking system, which could in turn increase bank funding expenses and reduce credit or raise credit costs for household and businesses. So some people are not pleased with this, but this debate, whether CBDC is good or bad, motivates our central research question, which is how. We're not going to talk too much about how, because a lot of folks have talked about how, but we're mostly going to talk about how much. Does CBDC influence banks' deposits? their credit provision, and their stability. So let's do this. How are we going to do this, especially the how much part? Well, when you think about quantitative things, you usually need a model. And what we're going to do is we're going to estimate the parameters of a dynamic industry equilibrium banking model. Here's a very, very quick outline of the model. Banks are going to, over an infinite horizon, maximize distributions to shareholders. They will face financial frictions. They will be imperfectly competitive with one another. And the customers of the bank will have preferences so that they have imperfect substitution between banking products. And then we take the model to the data on the existing US banking system. We do it in 2 bits. Step 1 is we want to recover consumers and firms' preferences. So we estimate a demand system for deposits and money. We call this public-private money via the Berry, Levinson, Pecos techniques, which is basically just a random coefficients logit model. Then we recover the sensitivity of demand to interest rates and to various different banking product attributes like convenience or can you do transactions. Then we plug those into our dynamic banking model and we estimate the bank's financial frictions and their costs using SMM. But okay, so fine, that doesn't sound like there's any CBDC bit there, and there is not. So what we do is we take some techniques from the industrial organization literature, and there is no CBDC in the model, so how can we counterfactually add it? We represent it as a new bundle of characteristics. In other words, we create a synthetic CBDC. Because we know how consumers react to these various attributes. We know how much they care about transactions. We know how much they care whether it's cash or not. We know how much they care about convenience. So what we can do is then we can attribute these different characteristics to a CBDC, create that CBDC. We can plug all of that into our model and see what happens to the banking system. So briefly, what do we get? CBDC does replace a significant fraction of private money creation, i.e. that it crowds out a lot of deposits. And the impact's bigger if CBDC pays interest. And banks become less profitable. They have a new competitor, CBDC. And so imperfectly competitive firms, when they get more competitors, lose profits. But what's interesting is the effect on credit supply is 4 times smaller than the effect on deposits. Why? So banks replace lost deposits with a lot of wholesale funding. And in the United States, this comes largely from money market mutual funds. Interestingly, the effect differs across large and small banks. When we estimate model parameters for large and small banks, we find that small banks are much more strongly affected on the lending side. There's an additional implication for bank stability. And so what CBDC does, it limits a natural hedge of interest rate risks from deposits. So what's that? In an imperfectly competitive market, deposit rates are very sticky. And so they match the stickiness of long-term loan rates, which are repriced very infrequently. And so you have sticky rates on both the asset and liability side. What happens with CBDC is that banks will substitute into interest-sensitive wholesale funding, and then they have a maturity mismatch problem, one that shows up in our standard undergraduate banking textbooks. So they're less stable. And what happens is they have slower recapitalization after shocks, and they respond more strongly to interest rate shocks. So that's the paper. Don't want to talk about the literature too much. There's almost no data on CBDC. It's not like we're going to go to Bermuda and ask them for anything because they wouldn't give it to us. So the literature has largely been theoretical. if you wanted to divide it into buckets, you could say there's the folks that look at the effect on banks, and there have been a lot of very nice papers either published or written there. Then other folks have looked at the macroeconomic implications of CBDC. We're going to do something totally different. So while our model shares and doesn't share different features with the models in this list, the one thing we do that is very different is we use data to discipline a quantitative banking model, so we can actually say something about quantities. Excuse me. Oh, let's dive right into the model. It's a dynamic, infinite horizon model. So there are three players. There are depositors, borrowers, and banks. Depositors and borrowers are both very simple entities. What they do is the depositors, each one of them has $1 and they want to figure out where to invest it. Borrowers each want to borrow $1 and they want to figure either how to borrow it, loans or bonds, or whether to just do nothing at all. The interesting part of the model are the banks, because those are the ones that make the dynamic optimization decisions. So what about CBDC? It's absent when we estimate the model. So when I go through the model, you will see no CBDC. But then we introduce it as a synthetic instrument to examine the predictions. Okay, let's do this. So this is the households all in one slide. And I realize this is a very busy slide, but I'm going to walk you through it anyway. So let's start walking. There's imperfect competition in the deposit market. So first, they're J oligopolistic banks. Turns out we match a Herfindahl index and we get 6. So what do households have? They have 2 times J plus 2 options. J is the number of banks. They can either do savings deposits or transactions deposits. So that's 2 times J plus 2. They can hold cash or they can invest in short-term bonds. So those are the options that they have. Savings, transactions, cash, bonds. And then they solve a simple little static random utility problem. So this is their utility from doing deposits. So it's red plus blue plus some shocks. What's red? RD is the interest rate on the relevant instrument. So it's 0 for cash. It's the federal funds rate for bonds. It's the relevant deposit rate for deposits. And then alpha I is the sensitivity of utility to the interest rate. What's Q? Q is quality. Okay, so now take your eyes down to the other blue part of the slide. That is just a product, an inner product of a vector of coefficients and a vector of characteristics. So beta D is a vector of sensitivities, and this is a vector of characteristics. And what does that contain? Things like, well, basically anything that we can get out of the call report data, because that's what we're using. So the number of branches, the number of employees per branch. We also have issuer and time fixed effects. And unlike usual panel regressions where you just say, you have this little line at the bottom of your table that says yes for fixed effects, we actually recover the fixed effects. We grab them out. And then we have a transactions convenience dummy. So 1 for transactions deposits, 0 otherwise. What else do we have? This C thing, that's just a demand shock. And then epsilon is interesting. It's a preference shock. So it's choice dependent. And you need it because we have perfect substitution here with linear utility. And so what this does is it induces imperfect substitution. Some depositor might get a shock and happen to just like cash more than deposits for some reason. So that's what this term does. Okay, so that's what the deposit market looks like. You've got the consumers, 2 kinds of deposits, cash, short-term bonds, and they care not about just the interest rates, but about different attributes of the different products. Done. Loan market's the same. They're the same oligopolistic banks. And what can borrowers do? They can do three things. They can borrow from a bank, so that's J things. They can issue a bond, or they can just do nothing. They don't have to borrow. In that case, what's their utility? There's quality again. And so this would be attributes of borrowing, such as either flotation costs or issuance costs. And then once again, this is the relevant interest rate on the instrument. So either a loan or a bond. And this is the sensitivity to the interest rate. And just like before, we have a demand shock and a choice-specific product demand and a choice-specific, say, firm-bank relationship shock. And that breaks the imperfect substitution. It also breaks the red bus, blue bus problem in logit models, which is great. Loans are long-term. A fraction 1/8 of the outstanding loan balances matures every year. Same thing with bonds. So both bonds and loans are long-term, and we set that to match the duration of C&I loans. So this part, so that's pretty straightforward. So the depositor and borrower problems generate closed form estimating equations. So the borrower's optimal choices are either indicator functions. It's 1 for option I or 0 otherwise. Same thing for borrowers. So we solve these little problems. We aggregate over depositors and borrowers, excuse me, and we get deposit market and loan market shares. And then if the shocks have generalized extreme value distributions, the shares are in particular a logistic function of rates and characteristics. And then we use BLP to estimate these logistic regressions. I'm just going to do one slide to show you what they look like. You don't have to look at all the math, but I want to point out one thing. So just look at the red stuff. So the red stuff is what we want to do is we want to estimate these logit regressions, and that does look like a logit. We want to harvest these sensitivities, the sensitivities to the rates and the sensitivities to the characteristics. So we harvest these alphas and betas. That's what's important. Okay, so I am done. Yeah, so why do we do that? One is really slick. It's a way to make the markets clear. So we have an industry equilibrium market, we have a deposit market, we have a loan market, and you need to set the price to clear the market. Normally, when you solve models, you have to do some sort of iterative bisection thing, but we don't. Because what we have in our banking model that follows, the banks choose interest rates, and then we know what the elasticity is, and we can just read off the quantities. And so the market's automatically clear, which is really cool. The other thing we do is we know how customers respond to the attributes of these different instruments. So what's the value of being able to do transactions? How much do they care? Like, what is that beta? What's the value of the cash fixed effect? What are the sensitivities to the interest rates? So we can harvest all of these things. Okay, that is the deposit market, the depositors, and the borrowers. So all they're doing is just solving simple little static problems, and we get logit demand functions from them. Done. Next, the interesting part of the model is the banks. So what I'm going to do is I'm going to tell you what's on the bank balance sheets. I'm going to do a little bit of an aside, and then I'll go in and show you what the optimization problem is. So banks have assets, they have existing loans, they have new loans, which are priced at this interest rate. They have reserves, and they can invest in excess in government securities if they want. They also, so those are the, and then so total assets are old loans plus new loans plus reserves plus government securities. And reserves and government securities earn the federal funds rate. And they have liabilities. So they have deposits, they have non-reservable borrowing, and they have equity. So deposits are insured, all of them, but non-reservable borrowing, so this would be, repos from money market mutual funds, are not. And default is possible under insolvency. So when does default happen optimally? It happens when the bank value is less than 0. But because default is a possibility, these lenders of non-reservables that we assume to be perfectly competitive, they charge a spread over the federal funds rate so that they just break even. There's some exogenous state variables in the model. There's the federal funds rate. So this is not, our model is based on some previous work where as an extension, we endogenized the federal funds rate. It didn't make any difference. So we went back to the old exogenous process. And so spreads on loans and deposits are set relative to F. So the banks choose the spreads, not the entire level of the rates. Delta T is an exogenous charge-off rate on loans. And FT and delta T follow a VAR1 in logs. We have data on the federal funds rate. We have data on charge-offs. And so we can just estimate this VAR1 and we can see how this process evolves. Okay, so real quick, bank has assets, old loans, new loans, reserves, government securities. It has liabilities, deposits, non-reservable borrowings. Deposits are insured, non-reservable borrowings aren't insured. And because they're not insured, banks can default. The lenders to the banks charge a little bit extra just so that they can break even, because sometimes banks default. And then there are these two exogenous state variables in the model. One's the federal funds rate. All pricing is relative to the federal funds rate, and an exogenous charge-off rate. We're going to estimate that process. Now I want to do one slide of kind of an aside, and then we'll go back to the real model. So this aside is an example of a one-period model that is just here to sort of fix intuition, and then I'll go back to the real model. So this isn't the real model, it's just a simple one-period framework. So what we want to do is we want to think about the role of the frictions in banks that, there we go, frictions in banks that make the CBDC affect banks. So what we want to do is we want to think about a frictionless benchmark. So we're going to consider a simple one-period model. There are no financial frictions. So that means that the lenders don't charge that little spread. There are no regulatory constraints. There's no maturity mismatch because it's a one-period model. And banks just maximize. They choose the rates on loans and deposits. They maximize the rate on loans times the quantity of loans, and the rate on deposits times the quantity of deposits. And both deposits and loans are functions of the rates because there's downward sloping demand. And then if loans are greater than deposits, they borrow. They have to borrow to fund these loans. And if deposits are greater than loans, they invest. Okay, here we go. Then you can take the first order conditions and mess around with them, and you get things that look very familiar. So the rate on loans is the federal funds rate plus something that looks an awful lot like a markup from undergraduate microeconomics. And the rate on deposits is the federal funds rate minus something that looks an awful lot like a markup from the undergraduate micro. But here's what's cool. So just a sec. There's no D in the first equation. And there's no L in the second equation. So these are separable. What does this mean for CBDC? So in this simple framework, if CBDC were to crowd out deposits, they wouldn't have any effect on lending. That's the first order condition for lending. Doesn't depend on deposits. And so without friction, we have what the George Panacki would call narrow banking. We have a bank has two businesses. It has the deposit business, it has the lending business, and they are not connected. So what's the intuition here? So let's say banks can frictionlessly access wholesale funding. Loans are just priced at the market interest rate. If they can access cheap deposits, that's great for them. That makes the deposit side of the business more profitable, but it doesn't do anything to lending. So there's an interesting quote from another Federal Reserve publication that says, given that the loan to deposit ratio is 1-to-1, every dollar that migrates from deposits to CBDC is one less dollar of lending is conceptually wrong. So that argument is out there. And so what it means is you need some frictions so that the two sides of the balance sheet get connected. This irrelevance result is also useful because it allows us to figure out exactly what is causing the CBDC to affect credit supply. We're going to look at external financing frictions. If you have more on, and this is one of the key bits of intuition in the whole model. If you have more uninsured wholesale funding, that increases funding costs and it could feed over into lending. What if there's regulation? CBDC would reduce bank capital because it makes banks less profitable, might constrain lending. And then what I talked about before with the DSS maturity transformation. Banks' market power makes deposits effectively long duration because the rates are very sticky. And if CBDC changes banks' asset and liability composition, that's going to change their interest rate exposure. So those are the three frictions that we will concentrate on. Okay, now that I've gone through and done this little aside, let's go back to the real banking model. The title of the slide is actually a Bellman equation, right? It's just a Bellman equation in words. Banks maximize over an infinite horizon discounted cash dividends to shareholders. So what do they choose? They pick loan and deposit rates. And then, because we know the loan and deposit elasticities, we can figure out what the quantities are. They choose reserves. They choose how much, in some sense, excess reserves they hold in government securities. They also choose non-reservable borrowing. Taking the behavior of other banks as given. So they're choosing all of these quantities, taking the behavior of other banks as given. So there is imperfect competition in the model. They're subject to constraints. The first one is trivial. What are dividends? It's how much you make from the deposit market, which is deposit interest, so it's cost deposit interests, and then net loan profits, and plus the change in equity. So that's just a standard budget constraint. But there's capital regulation. We're going to require equity to be at least as large as some fraction of loans. And we're going to require reserves to be at least as big as some fraction of deposits. And we're not going to allow negative dividends. This usually gets folks all twisted up in a knot because their intuition comes from static models. In dynamic models, this doesn't matter at all whatsoever. Why? In neither the data nor a model with equity issuance would we see much equity issuance. And so the predictions from a model with this much equity issuance versus no equity issuance are nearly identical. We have a robustness check in, I think, section something 7 of the paper. And then the bank defaults and is auctioned off when V is less than 0. So this is a hard model to solve. You have to solve the Bellman equation, but you also have to loop on the default threshold. And you have to loop on the competition because all the banks do what they do, taking the other bank's actions as given. So it's a pretty hard model to solve. And Yufeng is awesome. Okay, so that's the model. Now.
Hi, Toni.
Yeah.
I wonder if it's a good time to pause.
It's actually a great time. Let's do that.
Yeah, so we've accumulated a few questions. Most of them are concern the introduction of CBDC, and there's one question from the audience, Edward Dobson, who was asking, does the model that you just outlined answer for a banker the challenge of what portion of receivables should be held as whole loans, what portion should be securitized, and what portion should be sold to investors while earning service fees. I'll mention the CBDC questions after this.
So I don't see this in the chat.
So if
Oh, okay, there we go.
Yeah,
so,
from Edward Dodson.
Yeah. So the first question is just, this depends on the loan elasticities. So we have there's the curvature in this model that gives us nice interior solutions, depends on the loan elasticity. So if you have, depending on how elastic a loan, you just get an optimal amount. What point should be securitized? We haven't done securitization in this model. It's a little bit too much, so we can't get that far. I think that would change stuff a little bit, because it would mean that the lending market the profits would be a little bit different, but not a lot. What would still matter is that these frictions that connect the two sides would matter for how CBDC affects things. And then, so I think, yeah, so we don't have securitization in the model. My intuition is that would not affect how that affects the lending market, because it's the bits that connect the two sides of the balance sheet that matter.
Thank you. And the rest of the questions are all concerning CBDC. Toni Correa has a question on, for this type of CBDC that we're talking about. We think about wholesale versus retail CBDC here.
So we are not going to distinguish between that. So wholesale or resale, in this, what we're doing is we're just allowing the depositors to hold it, but that doesn't mean a depositor can't also be a borrower. So depositors and borrowers can have different roles. So I guess it doesn't really matter. Yeah.
And Joe Polito has a question on how do you envision the CBDCs getting into the economy? Is it through buying government bonds or through converting some of the reserves? I know in the case of China, the government was using a number of promotion programs and basically airdropping some coupons regionally.
Yeah. So I think probably that's the part that we're really going to not be, I can say something that's speculative, but I think that this has nothing to do with the paper. So how about if I say something speculative? I think it's really country dependent, right? China has done something different. Canada's considering converting some reserves. So I think that each of these things each of the possibilities that have been put forth are available, but I'm not sure. I think it would depend on probably the political situation in each country.
Makes a lot of sense. And Joe has another question on, could the banks borrow CBDCs at deposit rates as part of the wholesale funding?
Could they borrow CBDCs?
I guess that has something to do with the exact design of CBDC as well.
Yeah, I think that has to do with the design of CBDC. Yeah.
Okay, and maybe one more question, then we can move on. John has a question on, how can CBDC do any better than electronic cash? How does CBDC differ from government endorsed stable coin? I actually have a related question there as well. We do see the rise of e-wallets and buy now, pay later, right? Short-term credits. That's, has some version that's outside the banking system. It seems that the exercise that we're doing here can equally apply there, right?
I think
as long
that's
as
right.
they bundle some characteristics of what people
One thing that's interesting, though, is I think there are issues with security in anything that's issued directly from the central bank. Central banks are not set up to do security.
Right.
And so we'll think about, we will think about that later.
That sounds good. I think that's a perfect time to move onto the estimation part. Thank you.
I'm going to go through the estimation part pretty quickly. So remember, we divide our estimation into 2 stages, actually 3 stages. Some stuff is easy to estimate, like what's the average duration of C&I loans? We match the number of banks to get a Herfindahl index right. We estimate a VAR1, that's easy. The second part is we estimate the deposit demand and loan demand systems via BLP. And we get the rate sensitivities and the values attached to non-characteristics. And we take the instruments from a Ho and Ishii paper in 2011. And so we use the salaries and expenses related to fixed assets as instruments. The intuition is that they should shift costs, which is exactly what you'd want for estimating demand. We grab these estimates, we plug them into the dynamic model, and we estimate the remaining parameters using SMM. And we match moments. I'm not going to go over this terribly closely. We do a really good job on almost everything. And we have standard errors for the difference between the 2 things, except for dividend yields. This is a classic problem with this class of models. They never get dividends right, because dividends do strange things. They're smooth, they're not smooth. And this class of models just kind of blows it. On the other hand, we kind of don't care about dividends, so it's sort of okay, and no model can do everything. And then, so we have these statutory and fixed parameters. I'll talk about this digital premium in a bit, but this is just stuff that we fix. One thing that I want to talk about is a fire sale discount. This is the amount of the bank that gets destroyed in default. And we had a hard time estimating that within the model because banks don't default very often. And so it's really hard to get this to work. Parameters estimated separately. We have loan maturity and then the VAR parameters. And now I want you to take a look at 2 parameters from BLP. Take a look at this and take a look at that. Those are the important ones. They're unitless. We're trying to get Cong to convert them into something that's not unitless, but we haven't gotten him to do that. But what's important is that these numbers are finite. So remember, these are market shares. And so if you had a perfectly competitive market in deposits, then if I'm a bank, if I raise my deposit rates, I'm going to get all the customers. And so this sensitivity would basically be positive infinity. Similarly, if I am a bank and I raise my loan rates and everything is perfectly competitive, I'm going to lose all my customers. And so this would be negative infinity. So the larger this number is in absolute value, the more competitive the market. And so we find that the deposit market is less competitive than the loan market. I thought that was kind of an interesting bit. And then the rest, we just estimate with SMM. And most of this is to trying to estimate the bank's costs, because deposit franchises don't come for free. There are costs associated with it, and we want to estimate those. Okay. Done with the estimation, because that's, at this point, I think I've been doing this since like 2005. It's pretty standard. So now, how do we conceptualize? So there's up to here, there's no CBDC anywhere, right? Now we're going to do CBDC. So how do you conceptualize CBDC? It's just a bundle of characteristics. We're going to start with a CBDC that offers some baseline rate of return of 0%. Then we'll play with that. It allows households to make transactions, as do transactions deposits. So it allows for transactions to happen. As a baseline, we assign it an issuer fixed effect that is the same as cash. Why? Because it's a government thing. Just like cash is a government liability, so with a CBDC. But then there's something else about CBDC. It's not the same as cash. Cash is pieces of paper or pieces of metal, and CBDC is all digital. So we took this estimate from one of Cong's graduate students. What she did is she looked at what happened when banks introduced apps. which is kind of interesting. And she wanted to see what happened to deposits. They actually went quite up dramatically, like 20%. So we added a digital premium that we took from her paper, which is about 20%. And those attributes define CBDC. So that's our synthetic CBDC. Obviously, it's not going to capture every single characteristic of CBDC. Like folks have asked us about anonymity and so forth, but it's what we can get given our data limitations. And so that's our synthetic CBDC. You can do transactions, you get no interest, it's issued by the government, and it's digital. There's a lot of uncertainty in the quality of CBDC because it's going to depend on the exact implementation. It's going to depend on how the public perceives CBDC. They might not trust it, hard to know. And so what we're going to do is we're going to vary the quality a bit and see what happens. And here we go with the numbers. So first, we're going to vary CBDC quality. And what I want you to do, though, is to take a look mostly at column 1, column 5, and column 6. So let's start with column 1. This is when there's no CBDC, the share of CBDC is 0. The share of deposits is 0.876. So that's relative to the entire size of the market. So most of the market is deposits. Cash is a small amount of the market. And the size of the loan market is slightly higher than the size of the entire deposit market. So that the deposit market would be bonds, cash, and deposits. And loans are a little bit more. Why? There's a little bit of wholesale funding. The deposit spread is 1%. That's about right. The loan spread is 2%. That's about right. The bank credit spread is tiny. So this is the spread that the wholesale funders charge to do repos, and it's very small. Why? Banks almost never default. Look at what we just saw with Silicon Valley Bank. They were a disaster. They didn't default. They got bailed out. So banks often get bailed out or merged, and so they don't default very much, and so there's not much of a credit spread. And then the market to book ratio and the funding cost. Okay, now let's move over here. This is when we introduce CBDC. So it captures 7.6% of the market. Cash still has a little bit of the market, a little bit less, but not much. Why? In the model, it's because of that epsilon shock. Some of these consumers are getting these epsilon shocks that make them really want cash, so they want cash. One thing that is true in the real world about cash versus CBDC is the anonymity of cash, which is nice. And I think that's an attribute of CBDC that is not shared by cash. Deposits go down and loans go down. The market to book ratio goes down, the credit spread goes up a little bit. Next. Oh, and the deposit spread goes down. So banks shrink their deposit spreads. They are getting some competition from CBDC, so they lower their prices. Next, this last column is a slope. So it's what happens when you introduce $1 of CBDC. How many cents of an instrument does that displace? These are, so columns 1 through 5 are levels. This one's a slope. So if you introduce $1 of CBDC, deposits go down by 81 cents. So there's a huge outflow of deposits. So deposits go down. Cash goes down by a little bit, but what's so interesting is that loans don't go down by much at all. They go down by less than 20 cents on the dollar, which is quite interesting. I have the intuition on the next slide. So there we go. So the thing to take away from this slide is that when you introduce CBDC, and deposits get taken away a lot, cash gets shrunken a little bit, but loans don't go down as much, nearly as badly. So the effect on lending is much smaller than the effect on deposits. That should say 4. So why is that? The main margin of substitution is wholesale funding. Banks don't just sit there and go, oh no, I don't have deposits. They move into wholesale funding, and which is not that expensive because of the insured deposit. So they have a very low default probability. The other interesting thing is that the effect on aggregate credit is even smaller because these borrowers that are not getting loans a lot of them are issuing bonds. And so aggregate, they substitute into bonds. And so we don't see a lot of effect on aggregate credit at all. So a lot of this, the stuff that we've seen in these Federal Reserve publications that have said, oh no, it's going to destroy lending, takes away the idea, that just doesn't think about the idea that banks would substitute into other sources of funds and that this substitution would be not that costly. Next, what if CBDC pays interest? So, one sec, let me go back to the baseline counterfactual. Okay, so what I'm going to do is I'm going to take column 5 here, and that's going to turn into column 1 on the next table. So this is when you have a zero rate. They have 0.076, 0.814, cash still has a little bit, loans are down, but they still are greater than the whole deposit market. And what you can see is that the CBDC share, this is when the CBDC pays the federal funds rate, it takes up 31 cents, 31% of the market, which is huge. So paying CBDC, that would be a much more interesting thing for depositors. Deposits fall, cash goes down by more than it did, and loans shrink even more. Loans do shrink more. And so the sensitivity is a little bit higher at negative 0.82 cents. And loans which fell by 18 cents before per dollar now fall by 24 cents per dollar. So there still is substitution into wholesale funding, but if you let CBDC pay interest, then the effect on the loan market is a little bit larger. And in this case, banks' value goes way down. Next up. This is related to what I was talking about before. What if CBDC is intermediated through banks? I mean, really, can you see a central bank actually having to deal with customers, or this person stole my digital wallet? What do I do? These things, and these are real issues. And there have been security breaches with with some cryptocurrencies. So it's not entirely without worry. So in any case, they don't have the physical security infrastructure to handle public clients. Certainly what's the talk in the United States and Canada has been through a CBDC that is intermediated through banks. So it would go through a bank, banks would collect a fee. They couldn't use the funds, so they would just be a pass-through agent, but they also would not have a liability. So here's a quote from another Federal Reserve publication. An intermediated CBDC would reduce the prospects destabilizing disruptions to the well-functioning US financial system. So folks think this would be better. Not so fast. Two offsetting effects. The banks would like the fees. If they intermediated the CBDC and got some fees, that's fine. That's another line of business for them, and it's relatively profitable. The problem is CBDC would probably be more popular and crowd out more deposits because it would be more convenient. And so we model intermediated CBDC in two ways. We let banks earn a fee, and we let CBDC be more convenient. And so we assume that we assign to it the convenience of the availability of bank branches. And yes, I know people don't go to bank branches, but they do go to ATMs, and it's nice to have a bank around. So and in our data, it's our only measure of convenience. So take that with a grain of salt, but here we go. So the more convenient the CBDC, the more depositors want it. So let's say that banks earn no fees when CBDC is not convenient and goes through the central bank. The market share is 7.6%, and when it goes through banks, it's almost 37%. bank fees partially offset this disintermediation. Oops. So take a look at the last row. This is when they pay 0, and this is when, in column 5 is when they pay the federal funds rate. So the effect on banks lending is worse with the CBDC. This is what happens without, when it's intermediated through the Fed. This is what happens when it's intermediated through banks. And it's always worse. So that actually goes against what you might think, because CBDC becomes more popular, it crowds out more deposits. And even though banks do substitute into wholesale funding, it still hits them pretty hard. What about big banks versus small banks? We estimated the model on big banks versus small banks. And so in particular, we estimated an external financing cost for big versus small banks. And you'll notice for small banks, it's much larger than for big banks, almost 4 times. And then we redid the counterfactuals. So for each set of estimations, we created a synthetic CBDC and we fed it into the model. And so for the small banks and the big banks, the effect on deposits is about the same. The effect on loans for small banks is much larger. So it's a little over 3 times as large as the effect for big banks. And so that, I think, is something that's interesting. In the US, small firms are largely do business with small banks. And so this would have some interesting implications for who gets loans in the economy. Okay, I have enough time. I've been emphasizing over here that banks can get wholesale funding. So what happens when we change the wholesale funding cost? Okay, so this is one of these graphs with 2 sets of axes. And so red is the sensitivity of loan to CBDCs, and blue is the sensitivity of deposits to CBDCs. And so right here we have, and then different external financing costs. So let's start here with the reds. And so you're going to want to read off of the right axis. When the financing cost is low, then there's almost no sensitivity of loans to CBDC. Pretty cool. There's a little bit, because it's not the only thing that's going on, but the capital constraints might bind, and actually capital constraints might bind. So it's not 0, but it's very low. It's only about here that it starts to really bite. What about deposits? It goes in the other direction. And that's really simple. If wholesale funding is more costly, where do banks want to get their funds? More from deposits, because it's cheaper. So that's pretty straight. That's just a straight substitution effect. I'm going to skip that and go here and talk about the implication for bank stability. So the next thing we did is we did a 1 percentage point monetary policy shock without CBDC. So remember we estimated that federal funds process. And so what we can do is we can just shock it and feed it through the model and see what happens. And bank stock returns go down by 2%, which is quite interesting, because that's about what you see in the market. In our previous work, we actually did some event studies and took a look at this, and it's about -2%. What's going on? Banks with market power charge interest-sensitive deposit spreads. And so what happens is when you have a monetary policy shock, the interest rate goes up, so the cash becomes less interesting, and so you see this the movement out of deposits. Excuse me, you see the movement out of deposits because bonds become more interesting. The magnitude doubles when CBDC is introduced. So this 4% turns into this 2% turns into a little over 4%. And that's because funding costs become more sensitive. And that shortens liability duration, and gives the banks a maturity mismatch. And I'm done on time because that's what I always do. So we wanted to try to do something empirical on CBDC, even though there's no data on CBDC. So we started with a model, estimated the model, and made a synthetic CBDC. What are the main takeaways? CBDC does compete away deposits, but the effect on lending is much smaller. The effects are stronger when CBDC is intermediated or when it pays interest. Small banks are hit harder than large banks, and banks become more sensitive to interest rate shocks. And I'm done.
Thank you, Toni. I was trying to close the Q&A window on my side.
Oh, okay, okay.
Yeah. I think we can go to the Q&A to answer a few questions there, and then we'll have an open discussion. By the way, this is really really informative and insightful. One challenge I think we always face is, as you said, there's no data on CBDC yet. How do we do empirical work on that? And I think that's true in general for many fintech topics. There's a bit of engineering or design element, forward-looking design element to it. I think this actually sets a good example and template for research in that direction. Now, we do have a few questions from the audience. One of them is from Tyler Menzer. There's a lot of discussion now about how during times of uncertainty, deposits shift to money market fund that appear to be safer to depositors. So when thinking about CBDCs and shocks, it seems like the change in flow as a result of banking uncertainty should be very large. Tyler is just curious to see if your model offer insights on that as well.
Sort of. So we don't have changes in uncertainty because that's an extra state variable. But what we can do is look at loan default shocks, and that's something that we have done. And that does, so if without CBDC and there is a default shock, that hurts the banks. When there's CBDC, it hurts them more. So that's the only thing we can say about that. But what we cannot do the uncertainty thing because we don't have a state variable that represents uncertainty. But we can see what happens when there is a loan default shock.
Got it. Jose Canals Cerda has a question. What is the incentive for CBDC to pay interest, and why banks are the only intermediaries for CBDC? What about Meta or Twitter?
Oh, Twitter. or Meta. I don't know. We haven't thought about that. That would be interesting. I think what it would do to the banking system is probably similar to a direct CBDC. But so that's my intuition, is that it would be very similar to a direct CBDC, and not Twitter. Don't want Musk. Okay.
Kind of related to that, right? We'll talk about intermediate CBDC, the convenience part. It does get into the payment function of CBDC quite a bit. Yeah. And one synergy that bundling services would generate would be, there might be more transactions being done CBDC, and therefore a bank that's intermediating CBDC can collect more information, which help them to better loans. And that's very much in line with the theme of fintech, which is quite about rebundling and unbundling issues. And I think that would
look at something like that. It would have to be a little bit reduced for me because there's no information or data in the model. But I think we could do something with that would That would be interesting. I
Yeah,
like
it's
that
like
idea.
the volume of existing bank just
Yeah,
transaction payments or the data storage of banks. And
yeah. I think that would be something we could do. It would be a little reduced for me, but that's something that we could.
absolutely. And I think Joe Polito has a follow-up question.
Oh,
Couldn't the central bank lend CBDC at deposit rates to the banks if loan demand was not being met?
so this is interesting. We've thought about this a bit. Um, Central banks have this in their charters, they're not supposed to take on risk. And I think this would go exactly against that.
That's right. Because otherwise it would preserve the current structure to a large
Yeah.
extent.
Yeah.
Um, and we also have a question from Gordon Liao. Are there ways to reduce the effect on small banks since they provide more relational credit? Large banks lending seems to be more substitutable with bond market.
I think that's right. So this also goes into the whole how many deposits are insured with the Silicon Valley Bank, right? I think one reason why the cost is higher with the small banks is that they are not too big to fail, right? And so I think that a policy that would put them more into the too big to fail category would certainly help, but that would also be very expensive.
Makes sense. And Gordon has a follow-on question. Would there be a difference in the results if CBDCs are liabilities of the fiscal authority? For example, intermediate holdings of T-bills via a narrow payment bank instead of as a liability of the central bank.
So I think in our model, it would have no effect at all whatsoever. In a macro model, it would have a huge effect, right? Because monetary and fiscal policies do very different things. So this would be something that if you wanted to think about this question, I think the Fernandez Villaverde stuff and the Monica Piacese stuff would be the right type of framework to answer that specific question.
That's right. And I guess this is also related just in general, right? I think it's getting into the stable coin aspect as well. Curious to hear your view on, what direction is CBDC research heading into? Right? It's a little bit futuristic. We're still trying to wait for data, especially on the empirical side, and it has some interaction with private money, digital payments, and stable coins. It would be great to hear your thoughts. And as a piece of advice for researchers looking to working in this area.
The one thing we haven't done at all in this is just looked at like banks issuing crypto on the part of the government. So that's something that I think there are different forms in which CBDC could take that we have not looked at. And I think that's something that might be interesting. There's been a lot of theory work. I think at some point we're going to get data from the Chinese pilots, right?
Yes, I've actually been looking into that a bit. It's typically released through just news articles, sporadically in different areas.
Oh, interesting.
There's no centralized database yet, but hopefully there will be.
Hopefully
That would be very informative for
that
many
would be extremely informative, right? I think that's probably the first time you'll get action. So ours is sort of empirical. I mean, we are using data. Yeah, Stata was used in this.
That's right. That's right.
But I think that there's been a ton of theory.
Yeah.
For the theory, I think just looking at different forms of CBDC probably hasn't been filled out as much. And I think what we really need to do is just wait for data to see what actually happens.
Right.
Also, if Canada does it and keeps track, that'll be so interesting.
Yeah, and I do feel the CBDC experiment in China has been a little bit underwhelming, partially because it was very targeted. It was targeted at consumers' discretionary spending. You can't use it to trade securities. You can't use it, for mortgage and all that. So it's a limited set of usage. And that
Yeah.
actually relates to this question I've been thinking about for a while. So here we're talking about how the demand for different characteristics would matter, right? And also design of CBDC. I think the implementation of CBDC would also matter in the sense that is the introduction going to be restricted to a particular usage, even though the functionality is more encompassing, but the initial implementation is more restricted. But I guess that's hard to tell without actually seeing the experiment.
Actually seeing the experiment, right, right. Yeah.
Yeah. Alex Session has a question on with the introduction with a standardized CBDC, would an easier path be created for DeFi regulation? And as a result, open up additional competition to traditional finance. I guess this is related to how
Probably. I
data
actually,
might be.
I know more about, so the only guy on the Senate banking, on the House Banking Committee who has any idea what CBDC is this guy, is a guy named Bill Foster. He's a physicist. He's a member of the National Academy of Sciences. He actually does understand CBDC. He's very interested in regulating that.
Yeah.
So I'm not sure, just in the politics in the US, because of this one person who has a pretty secure seat who actually understands things, that would matter. I think what matters more is whether the Republicans or the Democrats control the Congress, because the Republicans don't care about it and the Democrats do.
That's right.
So that's what I know, just because I talked to this dude.
Right. The politics definitely play an important role.
A lot, right?
Yeah, I do think the question is very, very interesting just because it's hard to regulate DeFi. But to the extent that they all hold some CBDC, that's one way to get a toehold into that network and start to think about how to regulate or even tracking down illicit activities. Yeah, and Joe Polito has another.
Yeah. I knew this was gonna come. Yeah.
Yeah. So Joe wants to follow up on the earlier question regarding central banks stay from taking on risk. You mentioned that, right? Central bank, due to their mandate, they cannot take on risk. But Joe was asking, didn't they buy toxic assets back in 2008? And didn't they guarantee bank loans back then too?
Yes.
Would that be
And
considered?
that was pretty controversial. And also, it was a crisis. I don't think CBDC would be a crisis. But then you get into like who's head of the Fed. It's a little bit political, right?
Yeah. Makes sense. And let's see if there are questions from the audience who wants to speak over voice. We can definitely enable the chat or voice function. And while we wait for that, let me ask another very generic question.
Okay.
So you've edited many papers and you've seen large literature related to CBDC and also related to fintech in general. Given the challenges of this forward-looking design and engineering aspect instead of the empirical based on that type of work, do you have any suggestions for just PhD students or junior faculties who are looking into working on the topics? Because it might take a while for many of these innovations to fully materialize.
Yeah. Most of the fintech papers that come in they're the crypto papers. I give those all to a co-editor. Then the other fintech papers I do, and they're almost all out of China. It's all Chinese data. That's where the interesting innovation is happening. Not here, a little bit here, but not really.
Yeah, there seems to be a lot going on, and
Yeah.
also the model seems very different. The business model seems to be different.
Yeah.
Like here, when we talk about introducing additional payment apps, it seems to be directly competing with credit card of banks, whereas in China, the credit reference system wasn't quite developed originally, and it's more about synergy and creating an ecosystem. So it's
I think
definitely
that's right. And that's also true in a lot of developed countries, right? So
yes,
like in a lot of Africa, the telephone companies have become banks because
that's
everybody
right.
pays through their telephone.
Absolutely.
Yeah, so I think that's been quite interesting how it's developed in countries that had kind of digitalness before
yeah,
versus countries that did not. And I think the countries that did not are in some sense leapfrogging.
right. That's exactly the word, leapfrogging, and also all these economies are transitioning from cash heavy, super cash heavy, to cashless in some way.
Yeah, I think that's right.
It's very interesting. Um, let's see if there are more questions from the audience. Um, you know, the topic and the paper is definitely very thought-provoking. And I really think the general framework or this line of analysis can be applied to other areas as well. So I wouldn't be surprised there will be many follow-on work.
Yeah.
There are two questions from the Q&A. Let's just take a quick look here. So Gordon has a follow-on question on how do you think CBDCs would change monetary aggregate?
Probably go into M1, right?
Yeah,
It'd be M1.
that's right.
Yeah. Can CBDCs address the data privacy concerns associated with, I think that's DeFi platforms, by offering an alternative privacy-focused digital currency? So the privacy-focused thing is, I think, is the hard part, because I don't think the central bank can do that. They do not have the infrastructure. And that's why I think that so many, certainly Canada and the US, have thought about it more as intermediated through banks. And does the increased exposure to interest rate risk due to introduction of a CBDC affect DeFi platforms differently than traditional banks, considering their distinct business models and funding structures? Absolutely. I think that matters a lot. The DeFi platforms don't have these deposit franchises that allow them to banks to pay these low sticky rates that keep them going. And so I think it might, these alternative payment platforms might be less sensitive. That was total speculation.
And just related to that, I think for both DeFi and the CeFi, you know,
Oh yes,
yeah, the current regulatory rules or policies are not entirely clear. So that also depends. That's going to how the exposure matters. So those are great questions from Cong, and let's just take one final question from Auger Klein. Could an interest rate on CBDC increase the transmission effects of monetary policy? I think that's something already.
I think that's yes, that's something. Yeah, definitely. And that's something that is in our model, because it's based on our old paper, which is about monetary policy transmission.
That's right. That's right. That's a great point to conclude today's webinar. Thank you so much, Toni, for joining us and for your support, and also the advice and
invitation. This was a great chance for other people to listen to the paper, and thank you so much.
Thanks everyone for participating, and also for all the questions and comments.